What's employee benefits? Yes, what do we understand by employee benefits? Anyone? Do we have anyone? Employee benefits. What do you understand by employee benefits?
Employee benefits can refer to the entitlement that what the employees of a particular organization are entitled to for reason of being an employee of that organization.
Okay, anyone else? Anyone else on employee benefits?
Okay, sir. Uh, Employee benefits are simply uh, some compensations that is available to an employee for working in a company beyond its basic salary.
Any other person? Any other person? Any other person? So the last one that you said, the last person who gave us a definition, right? So I'll remove the last part of it. And that last part was when you said, uh, is it beyond the basic salary or what language do you use? What did you say? Did you say beyond the basic salary?
Yes, sir. Yes, sir.
Okay, so I need you to understand that the basic salary is the number one employee benefit. Do you understand? There is no benefits.
Yes,
There
sir.
is no benefits an employee is entitled to. Once you remove basic salary from there, you removed everything. All right. So that's it.
Okay, sir.
Now, employee benefits are the benefits, compensations, right? Entitlements that an employee is entitled to. Now, how is he entitled to it or why? For being an employee. The reason he's entitled to it, the reason we call it his employee benefit is because he's entitled to it, and that's because he's an employee. All right, there are so many other benefits that once you stop being an employee, you stop having the benefits. Do you understand? So those ones are not employee benefit. But employee benefits are the benefits you get as an employee. All right, and we have so many of these employees, right? We have the short-term employees, and that's where your basic salary comes in. Please, who is that person? Mr. Sulaiman, you can please mute yourself. So the employee benefits, like I said, the first employee benefits, the first benefit any employee can have is that is that short-term benefit, which is the salary, basic salary. So once you remove basic salary from there, there is nothing left. I hope you can hear me.
Yes, sir.
Okay. So once you remove basic salary, the rest is just minority. And that's why you see even directors. They want you to put a certain percentage of their salary fixed or as basic salary, right? So that's it. And we have so many other short-term benefits. Yes, what are we looking at? What are they? Anyone? What are the short-term benefits we have?
Bonus.
What type of bonus?
Annual bonus.
Annual bonus.
Or leave bonus.
Which one is leave bonus?
Half
Is there anything
salary.
called leave bonus? Is there anything called leave bonus? I'm just asking.
Medical care.
Like a leave bonus.
Like
Or
that would
leave
be leave
allowance?
allowance.
I believe allowance.
Yeah, you can have access to medical facilities as well, right? You can even have wardrobe allowance, right? So all those allowances you get, even your annual leave itself, apart from the allowance, right? Leave itself is an allowance and it's a benefit. There are so many companies that will pay you. In fact, normally when you go on leave, you still receive salary as if you were present in the office, right? Am I right?
Yes, sir.
Yes, sir.
So that's an allowance on its own, right? That's an allowance. And this allowance, there are also benefits that is applicable to an employee for being an employee. Do you understand? So leave allowance, short-term bonus like uh, wardrobe allowance, transport allowance, outstation allowance, all those allowances, all your earned income, right? They are all short-term benefits. And also we have the long-term benefits as well. The benefits are not short-term. We get them after 12 calendar months. So what are they? What are the long-term benefits we have?
Pension.
Yeah, pension and gratuity. Yes, what else? What else do we have, please? Pension and gratuity, yes, what else? Eh? What are the benefits you get after 12 calendar months? Have you heard of sabbatical leave before?
Yes.
Sabbatical leave is a long-term benefit too. Right? Sabbatical leave is a leave you enjoy. Your leave that is more than 12 calendar months is a sabbatical leave. It's also a long-term benefit. Any benefit that you get that is more than 12 calendar months is a long-term benefit. Right? You have study leave. Lecturers take that one very, very well. Sabbatical leave, study leave, we take it. Right? And we still have more of it. Do you understand? There are some benefits like share base, share option. Do you understand? Share option.
Yes, sir.
So all those things, they are long-term benefits. Right? Now we have the other ones which are post-employment benefits. Post-employment benefits are those benefits you get after you stop being an employee. All right. After you stop being an employee, all the benefits you get are post-employment benefits. Right now, these post-employment benefits, what could they be? Pension and gratuity is a post-employment benefit. Am I right?
Yeah.
You get them after you stop being
Yes.
an employee. Yes, what other benefit do you have? You know, some
Life
people,
life insurance.
sorry,
Life insurance.
life insurance, yes.
NHF.
Uh, NHF, okay, yes, all those ones are insurance policies generally. NHIS, NHF, and all of them. Yes, what else? What else? Yes, what else? Now, there are some organizations that after you stop being an employee, you still have access to their medical facilities. Are you aware?
No, sir.
No.
So there are some organizations like that. They will not take the medical card from you, right? So that's
I
what
think
they
that
are.
must be like you must like probably it's like a high management role. That's what I think.
Not only if you have a high management role, there are some people that they value you when you are leaving. They'll tell you that, see, you still have access to come back. And there are some people, as you are leaving, just don't come back. Some people, when they are leaving, they'll tell them that if anytime you feel like you want to come back to this office, you are welcome. Have you heard of that before? Like if you resign and they'll tell you, the company management will tell you that if at any point you feel like you want to come back, you are welcome. You want to come back to work, you are welcome. Are you aware of that?
No.
Yes, sir.
I'm
I'm
hearing
aware
it
of
for the
one.
first time.
Yeah, it happens.
That should be abroad. Oh.
It happens in Nigeria.
Oh.
It's Nigeria here, not abroad. But it's just one that I've
Yeah,
seen before.
I've experienced one too before. So that's it. Now, all those things are post employment benefits. Now, the last benefit we have is termination benefits or terminal benefits, right? Now, terminal benefits are those benefits that are offered to an employee. I think, according to the last study pack, now we have an old study pack and a new study pack, right? Now, according to the old study pack, right, it says that, or maybe it's in PSAV, I think it's in PSAV. It says that your post-employment benefit is that benefit that is offered by an organization to an employee in order to terminate his employment, right? Now, or the second definition, yeah, what do you say? What do you say? Okay, now the second definition is that benefits that an employee accepts. The benefit an employee accepts for his employment to be terminated. Do you understand? So that's post-employment benefit, right? So that's it. Now, all these benefits, example of post-employment benefits can be, what do we call it? This redundancy benefit, severance package, retirement package, right? Aha. So that is severance pay, not benefit. They don't call it. I think they call it severance pay. Yeah. So that's it. And Even I think the Finance Act of 2020 says that any compensation of loss, any terminal benefit offered to an employee, any loss, any compensation of loss of office that is not more than 10 million, it is not taxable. You understand? It is not taxable. Do you understand? So all these are post-employment benefits. Now, so we have all of them in this material, okay? Now there are some key things we need to look at. So under the short-term employee benefits, there are benefits that are due within 12 months of service, right? And the accounting recognition is to recognize it as an expense and a liability as the service is rendered, right? So ordinarily, it is a liability. Once you start offering a service, for instance, today is the second day of the month, right? Your salary for this month is a liability in the account of your employer. Now, when the month ends and they pay, it becomes an expense. Do you understand? So that's it. Now, we have some new terminologies that we have in the new icon study pack, right? And it's saying that the core accounting principle is to recognize it as an expense in P&L account, right? In the period where the service takes place, and also recognized as a liability for any unpaid amount or a prepayment for any amount paid in advance. Yes, so for your accrual of wages now, you debit your staff cost, which is your P&L account, credit your sales payable, salaries payable account. Anyways, that one is the double entry principle. I don't deal with double entry principles. Now, you can have measurements as well for it, right? And the measurement normally, how do we measure what's it called, employment benefit or employee benefit? Ordinarily, just like I said, you accrue it, right? It's a liability until you pay, right? And that's it. So once you now make the payment, then you expense it, right? So that's just it. Then also, what else do we have? Any other thing? So the icon study pack talks about some other things. The new icon study pack, I'm trying to use the icon study pack along with these notes, okay? So that's it. Now we have it also that says that for scenario whereby the unpaid benefit is at the year end, you accrue it as a liability and measure it with an measure the undiscounted amount expected to be paid, like your normal payment, so you don't have to discount it. And when benefit is paid in advance, you record it as a prepayment, carry amount forward and offset. All these things, they are still double entry treatment. Now let's look at constructive obligation, right? We have something called constructive obligation. I hope I'm still under this first benefit of what do we call it, short-term employee benefit, right? So there is an aspect of constructive obligation in the icon study pack that requires that an entity to recognize not only the legal obligation under the formal terms of a pension plan, but if there is any other constructive obligation, then we should record it, right? So we have to record any other constructive obligation, and a constructive obligation will exist when the entity has created a valid expectation in employees that if you pay the benefit, and that's constructive obligation. Now you talk about, right? That if we make enough money, or in the month of September we increase your salary, so it becomes an obligation like that. Okay, so that's what we have. Then also, A constructive obligation may be from a formal plan terms, right? A formal plan term. It can be management decision announced before the financial statement is authorized. It can be an established practice of settling similar bonuses in the past. So any of it can be constructive obligation. All right. Then what else do we have? I'm trying to look at the two materials actually. Okay, so I've seen post-employment benefit, but before they went into post-employment benefits, there is an information on termination benefit. Of course, the definition I gave you is also recognized here, right? And you recognize the termination benefit where the date of the entity is where as an expense, record the liability and expense at the earlier of either the date that the entity can no longer withdraw the offer or the date that the entity recognizes restructuring costs that involve termination payment, right? So the date the employer recognizes that we want to sack this person, we want to terminate his employment. So such a day will recognize the figure of that terminal or termination benefit. All right, so that's still that. So you don't really have much in the ICANN study pack. It's not too different from what we used to have. All right, now for the post-employment benefit, just like we said, right, we have the benefits payable. There are benefits payable after completion of employment, right? After you stop being an employee. Now under it, we have it as pension, retirement benefits, post-employment medical care, and the rest of them. Now, so there are two types of plan under it. We have the defined contribution plan and defined benefit plan. Okay, now the defined contribution plan says that an employer pays a fixed contribution into a fund and no further obligation. All right, I will explain this thing to you. I'm just reading the material first. And the second one says that the defined benefit plan is where an employer promises a defined benefit after retirement, and this one requires an actuarial valuation. All right, and it is recognized when the defined benefit obligation is recognized in present value of the promise, right? Then also we have something called plan assets, if there is any, and there will be a net liability or a net asset. That's after you've deducted your assets from your liability. So let's explain this post-employment benefits in details. So where we have defined contribution plan and defined benefit plan, so it simply means that your defined contribution plan, let's take a scenario where we have 10 staff in an organization. Each of the staff is getting 100,000 naira as salary, right? Now I want you to know that this post-employment benefit, the focus will be on pension now. Okay, I believe we are all closer to pension, right? Are we closer to pension? Do you understand what pension is? Hello, do we understand what pension is?
Yes, yes.
Okay. Now, so the focus will be on pension now. Okay. Now, we have 10 employees and each of them is earning 100,000. All right. So if each of them is earning 100,000, how much is their pension? How much is their pension?
8%.
What's the pension rate?
Employer
7.5.
contributes, why the employee contributes 8.
Employer
8%.
contributes how many?
10%, I think, if I'm not mistaken.
Employer contributes 10, then employee is 8%.
Contributes 8, making 18.
Now, which means from that 100,000, the employer is expected to keep 10,000 for each of the employees, right?
Yeah.
Yes.
Now, that's 10% of their 100,000 each. Now that 10%, 10% of 100,000 is 10,000, and we have 10 employees, right? 10,000 times, no, let's use 5 employees. 10,000 times 5 employees will be what? 50,000, right?
Yes, sir.
So that means the employer will be paying, apart from the salary of 100,000 every month, you also be paying 50,000 in general. 100,000 for each of them. 500, five of them will be 500,000, right? Am I right? 500, five of them will be 500,000, right? Am I right?
Yes, sir.
Yes.
So if 500, five of them is 500,000, then we are keeping 10% of it, which is 50,000 in a month, right?
Yes,
50,000 in a
sir.
month. Now, 50,000 in a month for 12 months will be what?
600,000.
600,000. So it means the employer is keeping 600,000 in a month for the employees. Am I right?
Yes, sir.
Okay. Now, that 600,000 they keep in a year for pension. Now, that 600,000 is a mandatory pension, right? It's a compulsory pension. Am I right? You
Yes,
must pay,
sir.
right? You must pay. Now, that means, and at the beginning of the year, as the employer is opening an account for your salary, he is also opening an account for your pension. And in that pension, we'll have 600,000 naira there every year, right? Am I right, guys?
Yes, sir.
Now, where the employer does that and keeps 600,000 every year, if in one particular year the 600,000 cannot go round to take care of pension for employees, the employer is mandated. The employer is mandated to complete that fund, to deposit more money so that your pension fund can be complete. Do you understand?
Yes, sir.
That 600,000 is keeping in a year. Now the question is, what can make the 600,000 not to be enough? Yes, can anyone tell us? What can make the
If the
600,000 not to
company
be enough?
doesn't make as
Addition of
much,
yes, sir.
Sorry?
if the company does not make enough profit in the year,
No, now the company has kept 600,000 in the account, but 600,000 is not enough to take care of it, to take care of that pension. Go ahead, sir.
Also, there might be an like addition of a new staff.
Yes, we can have admission of new staff. One. What again?
So, probably if there's like a raise in maybe anybody's salary, I don't
Yes,
know.
salary increase. Salary increment. What else?
if the insurance, national insurance scheme changes the rate, the company to have to increase
Yes, exactly. Where there is a
rating.
change in the pension rates, yes, they also have to change their own. What else? Any other reason? How about when there is uh, employee turnover? Eh?
When the salary of employee increase,
Someone has said that
you
before.
know,
I'm talking of employee turnover. What if we have employee turnover? And then some people are sacked during the year, new ones are recruited during the year. Are we still not going to have that issue of uh that issue of the money not completing or the money not enough? Do you understand? Now, regardless of the regardless of whatever reason it is, if the money is not enough, then the employer is mandated to complete that money. Do you understand? So that is what we call defined benefit plan, because it's part of the contract of the employees that we give them. Now you talk am. Do you understand, please?
Yes, sir.
So that's what we have under that part. The fact that you said it means you must give them. Do you understand? You must give them. So that is it. Now, in a situation like that, right? In a situation like that, if the money is not enough, the employer must add the difference and make it complete. But if it was, let's say we are also doing a contributory pension, you know there are two types of pension. One is a contribution, the other one is mandatory, one is voluntary, right?
Yes, sir.
Aha. Is it 1 hour to go? Yeah, 15 minutes to go.
15 minutes.
Okay, that's fine. So that is what we have there. All right. That contribution that we are now doing, if the employer also promises that, okay, your contribution, right, you want to be doing another contribution, a contributory pension, no problem, do it, and I will support in my own way. And let's say we still have another like 600,000 for that one too, right? 600,000. If the 600,000 in the account is not enough, it is not mandatory on the employer to make it balance, because it is a contributory pension. It is a contributory pension. That's why we call it defined contribution plan. So employer pays fixed deposit, fixed contribution into a fund, no further obligation. Okay? And the accounting treatment is that you expense it. All right? You expense the contribution when the employee provides the service. Expense it. All right? So that's it. Now, those are the two things under pension. Now, we have other long-term employee benefits, right? And this long-term employee benefit, they are the employee benefit that are other long-term. No, they are not. Okay, not due only within 12 months. They are not due within 12 months, right? Yeah, we have leave, long service leave, jubilee leave as well. Yes, there is jubilee leave. Yes, we have long-term disability, right? And of course, it's also similar to defined benefits, but simpler. So when we get there, we'll discuss that. Then we have the termination benefit, which I said, right? It is payable when employer terminates employment before retirement date, or the one employee accepts when employee accepts voluntary redundancy offer. All right. So you recognize the liability when the entity is demonstrably committed to termination. So that's that. Now, the key measurement concepts that we want to look at, we have the defined benefit obligation, right? So it's a liability and it's a present value of the future benefits earned to date. Present value of the future benefits earned to date, right? That's what we have there. I hope we can proceed, everyone.
Yes, sir.
Okay.
Yes, we can.
Now, the next one we have is plan assets. So now when you keep down your money, the 600,000, like I said, when you keep it in an account, it is called a plan asset. All right? So that is the asset you hold in a trust to meet benefit. Right? So that's it. Now, the next one we have is net defined benefit liability or asset. And that's where your defined benefit obligation minus your fair value of plan assets. The difference between the two of them is that you have a liability or you have an asset. And we also have actuarial assumptions. And this one, actuarial assumption can be the assumption now. For instance, salary growth, right? Then also we have discount rate, mortality rate, staff turnover. So those things that can change your what did I call it earlier? The amount you have kept, your plan asset, what can change your plan asset, and what can make that plan asset not to be enough. All right, so these are the things we have. Now we have to look at the presentation and disclosure. Right? Are you there?
Yes, sir.
Yes,
Okay.
yes, sir.
Now, the presentation and disclosure. So you must disclose the characteristics of the benefit plan, the amount recognized as an expense or liability, all right? The actuarial assumption, the sensitivity, right? What is sensitivity? Anyone? What is sensitivity? Yes, what is sensitivity? What is sensitivity analysis?
Sensitivity analysis is how one variable reacts to the changes in another variable.
I didn't get that. Your voice is breaking.
I said sensitivity analysis is the study of how one variable reacts to changes in another variable.
And okay, and that's like a formula. What else? What's exactly do you want? What's the objective of sensitivity analysis?
Me, I would say it's like a probability, like a what if, like maybe what if I may learn just this example, like maybe what if I have two routes to go to, maybe to avoid traffic. Okay, I go to this route. What's the probability that I might meet traffic there or I might not meet traffic? That's how I can put it, like a probability analysis. Yeah.
Okay, you have a point there, right? But the what it's a what if analysis. Please hold on, guys. Sorry, Becky, please reduce that voice. So it's a what if analysis, right? And the what if analysis is that what if it is let me bring it first before I give the example. It's an analysis that makes you think like a pessimist. You know who a pessimist is? Someone who is not optimistic, I mean, someone who will only think of negativity.
Yes, sir.
So it's an analysis of what if we don't make profit in our business? What if we don't sell up to what we budget to sell? What if our expenses is more than what we have budgeted for? What if our liability is more? What if our sales is reduced? What if the quantity sold or quantity that will be sold will reduce? So that is a what if analysis. Okay? So that what if analysis is sensitivity analysis. So the actuarial assumptions and the sensitivity analysis as well has to be determined. Okay, then also the risk associated with defined benefit plan. We need to look at that as well. All right. Now, I'll go into the ICANN study part. Please, that person can mute himself.
Oh, sorry.
I'll go into the ICANN study pack.
That's
Just hold
Suleiman,
on.
please mute your mic. You're disturbing.
I've muted you before now. Now, so I'm going into the ICANN study pack now, the new study pack, and let's see some of those things that we might also have there, right? Now we have the nature of benefit, that is the enhancement of other post-employment benefits, right, and how we treat it. So when you enhance other post-employment, this one is under termination benefits, right? So let me take them one after the other. Those ones that we have not mentioned before. Now, we have the enhancement of other post-employment benefits, which we treat as part of defined benefits, right? So the other post-employment benefit, we treat it as a defined benefit or defined contribution plan, right? So that's it. Then also we have payment expected within 12 months. Payment expected within 12 months, right? Now, the payment that is expected within 12 months is a short-term benefit, of course, while the one after 12 months is a long-term benefit. This, I think we are familiar with them. So they give us the categories of various long-term benefits that we can have, which we have mentioned. Then how do we measure a long-term benefit? We measure it, I think we discussed it as well here, where we have the present value of the obligation minus the fair value of your planned assets, and that will give us this net defined benefit liability or assets, right? Then also we have the components recognized in P&L accounts. All components of your long-term employee benefits do you recognize in your P&L account. Now in your P&L account, so there are some other terminologies. For instance, we have a service cost, right? Now service cost is a cost on the business. It's just like when you keep money in an account, there will be bank charges, there will be SMS alert charges, right? There will be maintenance of ATM card, right? Card maintenance. They will charge you for this one and that one, withholding tax. All those charges are referred to as service costs. Are we there? Hello, are we there?
Yes, sir.
So those are the service costs, right? Then also we have the net interest on the net liability or net asset, and that one is to unwind the discounts and return on planned asset. So we have something called return on planned assets. So they call it net interest on the asset or liability. Net interest or the asset of liability. So what we mean here is that when you keep money in the bank, you also receive some interest for keeping money with them, especially money that you are keeping in bank and you're not withdrawing, right? You also have interest on such money, right? So when you have interest on it, the interest you get minus the interest you pay or the charges deducted from your account, the difference will give us the net interest. All right, so the interest you receive on that account is referred to as return on planned assets. When you open a bank account that you are just funding the account, you are not spending the money there, there will be a return on that account, so we call it return on planned assets. Then also we have the remeasurement of the liability. We can measure liability as well when we have our actuarial gains and losses plus any return on that planned asset above or below the discount rate. So they'll give us the discount rate, of course, right? So we've talked about defined contribution plan, okay, and we've talked about defined benefits plan. What else is here? I think they just painted it differently. It's the same thing. Are we there, please? Are we
Yes,
there?
sir. Yes, sir.
Okay. So there is another part where we have multi-employer and state plan. Multi-employer and state plan. So before then, okay, I think I was making a note on some of these parts as well today, and let me see where I have that note here. I didn't put it here actually. I didn't put the notes in this material. But hold on, let me see if I can get the notes. It's a new Pathfinder, and there are little or no changes there actually. It's not like it's not like the what we have there is something we've never seen before. They are just little changes, right? So that's it. Hold on a second. So while I'm looking at the material, right, we can also be, while I'm looking for the material, I don't want to keep us waiting. Let me just see the overall there so that we can just take us through it. Now we have role of the actuary in pension planning and accounting. All right. So when we say an actuary, you know that I think uh, there are some universities that they have actuarial science, and that actuarial science is more like insurance, right?
This meeting is about to end.
Right. When they say
Now,
insurance,
bye.
it's like studying insurance. So an actuary is a specialized financial professional that is trained to assess and manage the financial implication of risk and uncertainty, particularly over long-term horizons. Right? Now, in the context of pension plans, actuaries provide expert advice to companies on how best to manage and fund their pension obligations. How many of us are paying pension here, sir? How many of us are paying pension here? Eh? How many of us are paying more pension? Hello? Nobody? Hello?
Yes, sir, you can go ahead.
Yes, sir.
So we're talking about an actuary, right? And is a trained professional in risk, probability, and financial forecasting. So they provide expert advice on pension, right? Now there are some people who will tell you that invest your pension fund into a particular investment, right? Because it is not all investments you can invest your pension fund in. And PFAs, there is a strict rule that guides their investment, the investment of their customers, right? There is a strict rule guiding it. Now, I think there is a particular package you can be on that you can choose your own investment. You can choose where your money, the industry or area where you want your money, your pension fund to be invested in. You can choose it. Yes, there is like that. Now, so these people, they provide expert advice, right? They give you advice on how pension plans should be designed, how it should be funded, how it should be accounted for. They use long-term assumptions, right? They use financial markets, employee behavior to ensure that pension obligations are met. All right. Then also they have their key responsibilities. The first one is contribution and funding advice, right? They recommend how much employers should contribute annually. All right. They recommend to keep their plan solvent and they ensure that assets are sufficient to meet future pension obligations. Then the valuation, they also have a responsibility of valuation of pension obligations, right? They value pension obligations, and this one is that uh, they estimate the defined benefit obligation using a projected unit credit method. They have a method of doing that, right? And they consider factors like life expectancy, mortality rate, employee turnover, what's your salary. I mean, employee turnover is number of employees who come and leave the business, right? the expected retirement age and length of service, salary progression and inflation, right? The discount rate. They consider all of this, right? So that's it. Now, they also have a responsibility to deal with surplus or deficit. Yeah, surplus or deficit, all right? And we have pension liability. When your pension deficit will be when your pension liability is greater than your assets, right? They will tell you to increase, we recommend that you increase your contribution. And when you have a surplus whereby your assets is more than your liability, they can advise you to have a contribution holiday, that is, you pause your contribution for a while, or they tell you to pause, they advise you on possible refunds, right? Subject to law and trust deed. Now, most times there is no refund from that account. You only reduce what you fund it in future time. Do you understand? You only reduce how much you fund the account in future time. So that's what we have there. All right. So that's it. Then also they have ongoing monitoring. Yes, they will measure your plan regularly. They update assumptions as economic and demographic conditions change. Right? Yes, they do that. Now, what else? What else? So their role in accounting. Their role in accounting, IAS 19 requires that pension plans are reflected in the statement of financial position as a net liability or asset, right? So if your what do we call this, defined benefits obligation and your pension and your plan asset, if your benefit obligation is greater than your plan asset, then there is a net liability. If your plan asset is higher, there is a net asset, right? We have movements during the year. Yeah, this is the actuary input, right? Now, movement during the year has to do with your payments during the year from that account, your payment of pension. So don't forget, you funded the account at the beginning of the year to pay pension, right? At the beginning of the year to pay pension. Now, when you fund the account at the beginning of the year to pay pension, every movement, every time you fund it, there is a movement. Every time you remove money from that account, there is a movement. So that movement also is what we consider as the actuary input. All right. So that's it. Do we have any question? Do we have any question? Go ahead, please.
Good evening, sir.
Good evening.
Yes, sir. Please, I'm just joining. I don't know if we are treating FM or FR, and I don't know the topic.
You are doing SBR. Do you understand now?
Okay.
Yeah, SBR. And we are doing employee benefit. Are you there?
Yes, sir.
Okay. Now, so this movement can result to your current service costs, which I mentioned earlier, that your current service costs are those costs that will be charged, transaction costs, right? That will be charged during the year. All right, yeah. So those transaction costs are what we have there. All right, the transaction costs are what you have. Now, transaction costs will be in your P&L account, right? And the actuarial rule is to estimate the benefit earned in the current year, right? So that's it. Now, you also have the past costs. Now, past costs are those costs you incurred in the past. For instance, it can be a previous month cost. At the end of the month now, and my bank will send me, apart from the charges they are deducting from every transaction, they will still send me about 980 something, I think last month. This month on the first, I received around 980 something naira after every charges on each transaction. I was like, what am I even doing on this account? Like, what am I doing? What exactly? Anyway, we don't have a choice. We have a choice. We can go back to our piggy bank. All of us will just withdraw our money from the bank. But anyways, that's that, Sha. Right? So we have those things there. Right? Now, we also have our net interest on net position. And that one talks about computing that using a discount rate. Okay, then also we have settlement. Settlement measures the cost of buyout or lump sum settlement from that account. So that's it. Then also we have remeasurement of actuarial gains and loss, asset performance, asset ceiling changes, right? Whereby we update our assumptions, the mortality rate, the salary growth, the discount rate, and etc. Okay, yeah, we have that. Now let's look at the plan assets, the actuarial rules on the plan assets. Okay, the actuarial rule on the plan asset, and that one is that asset must be measured at fair value. We discussed that before, and the component of that asset will now be equity, bonds, treasury bills, real estate property funds, and qualifying insurance contract. There's a calculation on this topic. This is SBR. Unlike in your PSAF that there was no calculation. PSAF talks about more of the theories. PSAF explains most of these things very well. My calculation is here. Now we have special cases where we have multi-employer and the state plan. So multi-employer, right? Now multi-employer is when two or more employers come together and establish a pension account for all their staff. So let's say for instance, I have a business and I have my employees, my staff, right? Then also, let me use one person on this call. One lady and one male and one female. So I'll take Mr. Ola. Mr. Ola also has employees, right? Miss Omishola also have employees, right? Now, those employees they have, the three of us will now come together and establish employee benefit for all our staff, in the sense that whenever my staff wants to benefit from employee benefit from that account, from that fund account, they will benefit from the fund account. All of us, three of us are, are running a single account for all our employees, and all our employees will have access to that account for their employee benefit. So I fund it based on the number of employees I have. Mr. Ola funds it and Ms. Shola also funds it, right? So the three of us will fund it. We can also have a state plan, and a state plan is the one that federal government will have for all the ministries, right? So all staff, all civil servants, Ministry of Finance, Ministry of Education, Ministry of whatever. The state also has something like that, whereby you open for everybody in your commission, right? So that's it. That's a state plan. So if your defined benefit information is unavailable, the plan is treated as defined contribution plan. Where there is no defined benefit plan information available, we treat it as defined contribution plan. And the actuary will help you to disclose why your defined benefit plan or accounting was not applied, right? Why? And also the contractual funding obligation that is available. Also, let me paste the last part of the information so that all of us can go to bed from here. Our calculation will come in our next class, not tonight. Okay, and I think we've even treated that. Let me see. Okay, so I think that's all. That's all we have for tonight. Do we have any question on this topic? Any question from anyone? Let's all be looking at our faces now. Any question from anyone? Yes, any question from anyone? Hello? Any question from anyone? No question, right? So in the absence of question, we'll meet in our next class, right? We'll meet to
Sir,
solve. Yes, sir.
yeah, thanks for the class. I really don't have any question relating to this particular topic, but it's just a kind of general question regarding the new study text that has just been released. I will appreciate your view on it. There are quite a few changes there and there, and the concentration of the exam too is kind of changed, whereby the section one carries, unlike before, is now 40 marks, and we don't have sections C anymore. It's just two sections. So, what's your perspective on this new text? What kind of advice will you give to us in relation to the fourth section, which carry a bigger weight? It seems if one is not well guided in that question one, it might as well just fail woefully. That's my thought. So, what are the core topics you think we can focus on that 40%?
Okay. So
Or I don't know,
I understand your
like
point.
like what we did in FRB. Okay, thank you.
So I
Thank you. I can
understand
hear
your
you, sir.
point, right? I understand your point that now if you have a 40 marks for question one, now the difference between 30 marks and 40 marks is 10 marks. Do you understand? So what ICANN usually does is that they can set that 40 marks on a single topic, but most times they will bring at least two different topics to that 40 marks. The first topic can take up to 30, while the remaining one, the second one will now take 10, right? So it means that that topic is your case study for that course, right? That's why question one is a case study. So now, usually, I am not someone who predicts top questions. I'm not someone, I don't know if anyone has attended my class before, I'll tell you that. I'm not someone who predicts question that, go and read this one. It's been long, I can't tested it. I don't do that. Right? Usually, I, probably because of the way I train myself in such a way that I read from pali to pali, right? I don't leave any stone unturned, right? And especially the fact that during my time, I had no access to tutorial centers. There was nothing like online classes like this, and even the physical class, we were too busy for that during our own time. While I was writing ICANN, I was still in school then, and of course, as I was writing ICANN, I was also training other students who are writing ICANN, right? So that's it. So what I usually tell students is prepare. The essence of ICANN is to learn everything, at least be 90% ready. So someone like me, saying at least, I can tell you it's a mistake, but some people 90% will suffice, right? Now, what if 10% is what that 10% that you have left is what ICANN is testing? Do you understand? So in my own case, I'll tell you to please study as much as you can, solve questions, and that's why we are taking them chapter by chapter. We are not saying that this one is not relevant and then let's skip it. We are not skipping any chapter, right? And practice with Pathfinder questions a lot. Yes, it might take 40%, but there is nothing like a begging question anymore. All the questions have been set before, right? All the questions have been set. They can just twist it and twist it and twist it, but they've been set before. Do you understand? So practice with all. And ICANN exam is not an AOC exam where you get area of concentration or area of confusion. Some lecturers are very good at it though. Don't misquote me. Some lecturers are very good. They will tell you to read this chapter, read this one, read this one. They will predict it and it will come out. Yes. But honestly, I don't know how to do that. So that's why I advise students to please read everything readable. Alright? So, any other question from anyone? If that answers your question, I think we can call it a night here.